Well, there's a reason why the policy merits discussion on day two. The market had gone yesterday into the policy expecting dovishness, which it didn't get. And so equity markets fell, with the governor saying that stance change depends on the bank's transmitting rate hikes. There was no word on cut. However, bond markets were happy yesterday a bit on the understanding that the Reserve Bank will keep adequate liquidity in the interbank system to let the call rate come down to 6.5% from 6.75 last year. However, after the policy, the Reserve Bank announced a much smaller than expected repo auction. Repo is where the RBI gives money to the market. So since it gave lesser, 1.7 lakh crore, where the market was expecting 2.5 lakh crore, the call rate today has jumped to almost 6.8% in trade. So this counts as a hawkish policy. Now, how do we therefore understand the policy on day two? I have with me Sonal Varma, the Managing Director and Chief Economist at Nomura India, and Suyash Choudhary, the Head Fixed Income at Bandhan Mutual Fund. Suyash, I'll come to you in a bit because the call is a bit technical. Let me first dispose of the macroeconomic questions with Sonal. Sonal, what did you take away in terms of the stance change, in terms of timing of stance change and rate change?
Not much in terms of takeaway from the decision. In fact, we look back at the last 5 years and more and how the stance has changed. And it turns out the stance change is usually an afterthought after the policy action has already happened. So it is quite possible that even this time the MPC will change the stance much later. So, we think the stance is no longer a good forward guidance of what is to come on rates. As far as the rates are concerned by themselves, we did see dissent from Jayant Verma. Our view is that there will potentially be more dissent in the April-June meetings from another external MPC member. In terms of the timing of the actual cuts, we have headline inflation going below 4% and around 4% after June. So we still think that the first cut will come through in August.
Suyash, again, I'll come to the call rate in a bit. What are your expectations in terms of rate action from the Reserve Bank?
So, Latha, I agree with Sonal. If you see even the 2019 rate cut cycle, the RBI was in a calibrated tightening mode, and you actually got a rate cut and stance change at the same meeting. So the way we are thinking about this is there is a rationale given for the stance, which is incomplete transmission and inflation yet to be aligned to 4%. And then there is a context to the stance, which is that RBI still thinks FY25 growth is going to be 7%. Now, if there is a rethink going forward basis concurrent data that growth outcomes may be slightly less strong compared to what RBI is estimating today, or if there were global events that were to force the hand, then the stance will not come in the way of any sort of a rate cut in the future.
So I think it's best to ignore stance, as I think Dr. Jayant Verma once said. Okay, Sonal, let me come to the growth and inflation forecasts. What are your forecasts? And how do you rate RBI's 7%?
Right. So our own forecast, Latha, we have actually revised up our growth projections slightly for FY25. We are no longer in the US expecting a recession. So we've upped to FY25 to 6.2%. We were a shade below 6% earlier. So this is better than what we expected earlier, but still below the RBI 7% projection. We do primarily think that the capex side will slow in an election year, and the tightening on liquidity and on macroprudential norms will, over a period of time, mean some cooling off on discretionary consumer demand. So we are building that into our forecast. On inflation, the aggregate projection of 4.5 that the RBI has is in line with what we have. But the one-year forward projection, which is the last quarter of FY25, we have inflation actually closer to 4% rather than 4.7, which the RBI has. So on our baseline, we will have an undershoot on both growth, inflation, real rates will be more positive than needed. And therefore, we have about 5.5 as the terminal repo rate. So 500 basis point in cumulative cuts in FY25.
Okay. Well, Suyash, I think the bigger question is on liquidity. My sense was that when you read that paragraph 21, Reserve Bank seemed to say that they will use repo and reverse repo actively. And I got the feeling that, I thought many in the market got the feeling that they will keep the call rate at 6.5. Now, look what has happened in the evening. They announced a smaller repo and today 6.8. So, I mean, the bond markets were happy yesterday. Were they all wrong?
Rather, the confusion with respect to liquidity really has cropped up since late last year when the RBI has seemed to focus on the quantity of liquidity in the system as well. If you recall, the earlier framework, in fact, even currently emphasized is that we need to manage weighted average overnight rate using the variable rate tools. Implicitly, there is no concept of quantity of liquidity in the system in this framework. However, since late last year, after the ICRR and then the OMO sale suggestion, there seems to be some discomfort with quantity of liquidity in the system. And, as it turned out, the RBI didn't have to do anything. Government cash balances swelled up, but we saw long periods of time when overnight was at 675 and RBI seemed okay with it because, they didn't take very aggressive action to bring it down to 6.5. Since January, we have seen a change to that. RBI seems to have gotten more proactive in managing two-way volatility in the overnight rate. Now, yesterday, you will recall both the governor and deputy governor reaffirmed that the intent is to keep around 6.5, frictional liquidity considerations notwithstanding. But some amount of market confusion with respect to this is understandable because the behavior over October, December seemed to suggest more tolerance for 675. The behavior since January seemed that there's some rethink happening to that. And what you allude to is happening this morning is probably some bit of more food for thought. But the base case is, given that core system liquidity declines from around 1,80,000 crores today to probably around 75,000 crores by 31st March, and government cash balances obviously will be swinging, we would expect overnight to be between 6.5 to 675, and it will entail active liquidity management as the governor and DG committed to yesterday.
Okay. Well, actually, I have a fund manager and an economist with me. Maybe I should have got a banker as well. But Suyash, this is very much a banker's problem. As long as call remains so high, they are forced to raise more money via deposits. That becomes an attraction. And for me as a consumer, I am very happy because I can lock into higher FD rates. Since I don't have a banker, I want to ask you that question. What is your sense? Do you think we are going to continue to have higher deposit rates?
Latha, the essence of the issue is simply this, that M3 is equal to money multiplier into reserve money growth. And reserve money growth is entirely the domain of RBI. And, basically M3 growth in relation to nominal growth rate is probably not keeping pace in the real world, because reserve money growth is tighter than what it may have been, because RBI wants to force more transmission, and that's understandable why the reserve money growth is more muted. But banks cannot create money, so credit expansion does not lead to liquidity destruction, only to the extent that some of it leaks out in currency in circulation. It is really the pace of growth of reserve money, assuming a constant money multiplier, that will determine how much pressure there is to bank deposit growth. As of date, there is significant pressure, but I think it's line with what RBI wants to do is to basically, get the next 50, 70 basis points of loan rate transmission, which will complete the entire monetary policy hike transmission cycle.
Okay. Well, I think this is more either an MBA economics class answer or, an Indianomics answer. Short point is you are expecting deposit rates to remain high, right?
Till 31st March, because we are in the midst of busy season on credit, we do expect deposit rates to be high. From April, two things will happen. We will shift to lean season on credit. And by April or maximum June policy, liquidity should start to turn with active positive intervention from the RBI. So we think the high deposit rate phenomenon is now for the last leg of this.
Okay. Got that. So those of us who want to lock into high deposit rates have time till March 31st. It looks like the deposits are going to, give us a decent bit of money. Now, final question to you, Sonal. We have always been speaking about global headwinds. But look at the way US GDP numbers are coming and the S&P at 5,000 all-time highs. Likewise in Japan, growth is good and so are the stock markets. are we understanding global headwinds as wrong? Two big economies are actually growing well. Globe is not a headwind, it's a tailwind, would you say?
I think so. At the margin, yes, Latha. Over the last 12 months, even though US growth was more resilient than expected, the global financial conditions and just the volatility spillovers from US financial markets was a big challenge for EM economies. I think currently it is a good space for EMs and India as well. So you have good growth. We have commodity prices that broadly have remained in check despite the geopolitical tensions. And there's a debate about when the Fed will ease, but we know that the broad direction of US monetary policy is towards easing now. So I think the combination of global growth, commodity prices, and broad US financial conditions are generally more positive for emerging markets and for India, of course.
Okay, actually, that's a positive note to end this conversation. Suyash and Sonal, thank you very much for joining me. Well, the key takeaway from our conversation is that the market went in expecting that RBI is going to keep the call rate lower. Today, it doesn't look like that. So, money maybe likely is going to remain tight, and therefore, banks will have to pay higher amounts of money for deposits. That's a positive takeaway for consumers, not good for banks and bank investors, because that will mean margins will be under pressure. But the second takeaway, that growth is actually pretty good, even globally, and therefore, RBI's 7%, even if people like Sonal don't agree, it has a good tailwind from global growth, and therefore, we are good on growth, but rates are going to remain high. With that, we wrap up on Bazaar. Chartbusters up next.